All right, welcome to today's video, everyone. We're going to cover the hidden trade behind the GLP-1 boom. Everyone knows about the Ozempic, peptides, and all the wave in weight loss that is happening worldwide. That has created an amazing trade opportunity and long-term investment opportunity. However, I think that some of it has fallen into the overly optimistic expectation side of the market and also created an overly pessimistic expectations corner. I covered this sort of setup in the AI trade versus software. That has been playing out very well every time the AI trade constituents fall. Software tends to rally and vice versa. So I think a similar setup is being set now in the GLP-1 names versus some of the consumer names in the economy. So we're going to get into that in a minute. But before we do, I want to mention a recent call, sort of housekeeping in Domino's Pizza, right? So this is part of our Offside portfolio. I made an entire deep dive on the company a few weeks ago, almost 2 months ago now, as far as what we're buying, why we're buying it, and where we're looking to sell it at. Less than 2 months later, this part of our portfolio is already up 7% pre-market today, as the company reported amazing earnings. All of the supply chain thesis that I pointed out to you in that report started to bring absolute beautiful profits and growth rates as far as return on capital and margins and market share. So we're going to hold on to this one. If you got into it, congratulations. I do expect a lot more upside from here. Goes to show that the Hilo names are starting to pay out in the Offside portfolio and the screen thesis. So now let's get back into today's topic, and this is every boom, right? Every investment boom, every capital and popular boom creates an opposite and equal opportunity, right? We saw it in the AI trade versus software. That's starting to take on water now. It's starting to grab a lot more traction when it comes to the retail space and media and everything else, right? Now, on this one, I want to spot the opposite trade for GLP-1s, right? So, money is flooding into one theme. That is the Ozempic, the Wegovy, the weight loss in general products around the GLP-1 winners. Now, snacks and beverages were left for dead, right? So, you have really amazing companies and big brands that own the industry, such as Pepsi, Coca-Cola, Mondelez, Domino's Pizza is one example, already rebounding. You have Chipotle, you have Cava. A lot of these places and brands are getting beaten down because of the winning streak in GLP-1 names. Now, that's not bad, it's not good, it's just the way that the market is acting right now. And I think that creates an opportunity. So now we have to test the story so far. And the question is not whether GLP-1 will change behavior in consumers, because it already has, right? Everyone that tells you that Ozempic and peptides is not going to be a big thing or a bigger thing down the line is honestly dead wrong, right? We don't want to call that. We want to call what the market is overshooting as far as the negative narrative. And again, we can call the overshooting in the positive narrative as we are in the AI trade, but I don't think it's time yet for GLP-1s. Now, this is where we ask, right? Is the market pricing in more change in consumer behavior than history is showing and that reality is looking to deliver? That is the entire premise of this trade. Now, we have to prove the mechanics behind this call. And first of all, we have to study the healthcare industry sector, and then we study the consumer cyclicals, defensives, and staples sector as well. Figure out what drives them, what sort of behavior we can expect, and whether the mechanics have broken. Now, right now, they have broken, and we're going to get into why that is in a minute, and how that creates the opportunity itself. Now, the trade is we're looking to buy the overpunished consumer basket that I've created, and I'll show you in the next couple of slides. And we'll build it around a filter that most people never think to run. And this is exactly where the value is going to be delivered to you. So stick with me for a few minutes. Now, this is a long on the loser, right? We're not going to short the drug. We're not going to short or ignore the fact that GLP-1 is going to keep on growing, it's going to keep on delivering results and becoming more and more efficient as far as cost and economies of scale go. right? I mean, GLP-1s are centered around the US. Over here in Europe for the summer, I was in Asia last year and have been traveling, covering many, many themes around economies. And GLP-1 is not one that has spread outside of the US just yet. So I think that the growth potential is still there. We can't ignore it, we can't short it. But what we can do is ride a tailwind on the areas that have been overshot lower. Now, the crowd obviously is going toward the GLP-1 winners, the Ozempic winners, the peptide winners, and they're shorting the snacks and soda losers, right? So just as every dollar went long on AI names, and then probably 30 cents of that dollar went short software names to hedge out the risk, I think a similar setup is happening right here in the GLP-1 versus consumer names, right? So for every dollar that goes long GLP-1, there's probably some significant amount going short these consumer names as a hedge. And whenever that trade converges, that's where we can make a lot of money. Now, the offside read, the expectations investing, the offside read that we like to always apply is that we want to buy the overpunished basket. We bet the spread converges, as I mentioned, and not that the drug fails. That would be futile. And then we get paid when optimism proves that it's overdone. That it's as simple as that, right? Now, we've run this play before, as I mentioned, in the AI versus software, right? That spread has been played out. The correlation spread that needs to converge is already doing so, and it's paying up handsomely in names like Adobe, Workday, Microsoft, right? Now, I think the same setup, not as intense, obviously, but the same setup is in the consumer space. And we can start with looking at a handful of names, but I'll just mention one real quick here to save you time. This is Pepsi Cola in white and then Eli Lilly in purple, right? They tend to move together most of the time. Now, starting in the first quarter of 2026, you see that Eli Lilly is just shooting up higher while Pepsi is shooting up, is declining and plummeting lower, right? So what happens here, this is not contained to Pepsi and Eli Lilly, right? This is McDonald's, this is Chipotle, this is Cava, this is Celsius, a bunch of consumer names. So when you take like Pfizer, Eli Lilly, you take other names involved in the weight loss industry and the drug making industry, that this seems to be the case now, right? One shoots higher, one plummets, and it's all because of the weight loss narrative. Now, why should they move together at all, right? And this is exactly when we start digging into the factor behavior, right? Now, the right question isn't, is this going to change, right? Is how much is already priced in, because the change is already present. The change has been made into the sector, into the consumer trends, into the economic values of these companies. Now, the question used to be, roughly 3 years ago, will GLP-1 change consumer behavior? Now, the question is becoming very quickly, is more changed price in more than will happen, right? Is more change coming? We've already priced in a bunch of change, a bunch of consumer trends shifting around those weight loss tendencies. Now the question becomes, is more coming? Is it overdone now? Are we shooting too far into the future? And every drug maker is starting to answer that question for you, right? So you have Eli Lilly. They just released the first pill form of weight loss drugs in April 2026, which means cheaper, faster delivery, lower cost for manufacturing, better adoption, right? When you tell somebody, well, you can lose weight through Ozempic, but you have to inject yourself many times a week, and might be painful, might not be, might catch an infection, whatever it is, the adoption rate slows, right? you think about it more. But when they tell you you take a pill and you lose weight and this is going to happen the same way as in the injection, well, I bet a lot more people are going to adopt it. And that's exactly what's happening. Now, what happens now is that the biggest catalyst for the GLP-1 trade is done, right? The pill form came in, it's already done. Now the market has very little forward to look into. It has very little catalyst down the line to keep pricing in more change. Meaning most of it is already priced in my opinion. Now, again, I'm not saying short the GLP-1s or ignore them, because more change could come in the sense of more competitors could come in, right? Like Pfizer could come in now and say, we have a better pill and it's cheaper. And then let's say Merck comes in and says, we have a much better pill and it's much cheaper now. So what happens now is everyone starts building. That leads to oversupply, pricing wars, and that compresses margins for everyone involved. That compresses earnings for everyone involved, and then eventually valuations re-rate. And that's what we're starting to see slowly in the AI trade as well. As every single player, every single competitor starts making better chips, better data centers, better everything, better models, that leads to oversupply in both the physical sense and the capital sense. That leads to pricing wars. We're seeing it now with China last week, and that leads to lower margins, lower valuations for everyone involved. Now, bring that into the GLP-1 space. It's starting to happen, right? Eli Lilly was the first. So eventually, we're not at the peak of that cycle yet, but we could approach it very quickly if more and more competitors step into the scene. Now, there's a sweet spot for capex, right? And we covered this in a previous video. When you invest too little, and you can see it at the left tail, when you invest too little capex, right, like 1%, 1.6% of free cash flow goes into capital expenditure, historically you tend to grow your return on asset base by 7.5%, right? So that's not great, but it's not mediocre, right? It's just in the sweet spot of breaking even, right? Then you go just right in the middle when you have 6% roughly intensity on capex. You get an above average return on assets, right? The average American business makes 10% roughly. You would be making 13.3% if you hit that sweet spot on capex. Now, when you invest too much, which is 15% or more on capex intensity, suddenly your returns go down below the mediocre 7%, right? So what happens here is you have to begin spotting industries and sectors that are over investing, and then you can project the future returns, the future margins, the future economics of the industry based on that overinvestment, right? That doesn't happen from one year to another. It has to build over time. Now you have ASML, TSM, you have a bunch of companies doing this. Now that's in the AI space. But when you look into the GLP-1 trade that we're talking about, that's going to be Eli Lilly. Then it's going to come Pfizer, Merck, and AbbVie, and all these other companies may start to come in and overinvest and then deplete margins for everyone else. So while that happens, we don't want to just stare at the trade and do nothing, right? So we begin by breaking down the behaviors between the two sectors, which is consumer staples and healthcare. Now, when you break down the factor exposures, this is essentially what drives the ETF as far as price action, right? And you can see that they're pretty much the same. They have the same betas in the sense that they both move from the breadth, from quality, from value, and in the market, right? So if they share the same betas, it's because they're part of the real economy, the real defensive economy, right? So not that much growth, a lot of free cash flow, a lot of high margins on the free cash flow, high quality earnings, and everything else that involves healthcare and staples, right? So the beta just broke, one of them, right? Not every single one, but one broke because of GLP-1, and that is the growth, right? So staples and healthcare are not known for high growth rates on their earnings, right? So what's making the baskets diverge from each other, I think, is the growth aspect, because now you introduce GLP-1s, you introduce robotics into healthcare. That's going to have a much higher, a much more aggressive growth rate assumption on the sector, breaking away from the staples, which haven't seen much as far as catalyst and as far as new factors in the growth equation, right? So that break is starting to get questioned, right? As you have more participants come in, as you have the inflection point for margins and valuations, I think that we could start looking at longs in the consumer sector, and then GLP-1s, we could have it as a run-up, right? As a late stage momentum play on the growth of the healthcare sector. But when you want to look at the highest risk reward, I think it's in the consumer names. So I made a basket of each that we can compare and match those performances and see which one is starting to take over the other. So on the consumer side, which is my long, we're going to have names like Pepsi, Coca-Cola, Mondelez, McDonald's, Yum Brands, Chipotle, and Celsius, right? I'm not saying buy every single one. This is only for tracking performance purposes, right? Now, you have the GLP-1 names. That's going to be names like Eli Lilly, United Health, Hims & Hers, Pfizer, Merck, and AbbVie. So again, we can track the performance of these baskets. What we can see now is that the volatility obviously has been in the GLP-1 basket, right? They had a huge drawdown in the Iran war breakout, a huge run up again, and now it's matching the beginning of the year where the consumer basket essentially did nothing, right? So even though Pepsi and Coca-Cola and all these names are underperforming, while the GLP-1s rally, when you look at the cumulative performance on a year to date, they're the same, right? So the fact that it's not outperforming the other, the fact that the volatility is so concentrated into GLP-1s confirms the fact that we have an overcrowded trade potentially, that we have a lot more changing as far as assumptions for the future growth. And that is essentially why I think the trade is attractive. There's a lot of attention going into it, and the same attention should be headed into consumers, but it's not, right? So if those correlations sustain themselves on the factor beta exposure for the two sectors, I mean, economically, they're pretty much the same, right? If that stays true for longer, even after we price in the growth in robotics and GLP-1, then I think the divergence should converge. And this is where correlation analysis comes into play, right? So we have the correlations, rolling correlations for GLP-1 baskets and the consumer baskets, right? So as you can see, they're pretty cyclical, right? So every 6 months, every year, they tend to peak and then they trough and then they peak and then they trough, right? This isn't as jumpy as something that wouldn't be as correlated as these two sectors, right? So the fact that they trend in correlation for 6 to 12 months is a positive sign. And right now we're coming off the lows that were made in early 2026, and now we're going toward the cyclical highs that should last towards September of this year if history repeats, right? So what I'm saying is, whichever name needs to adjust will adjust by the end of the year based on the historical behavior. So whether that is the GLP-1s falling to match the consumer names, whether that is the consumer names rising to match GLP-1s, or a combination of both. Now, when I look at the three ways that the spread can converge, I think the better bet is on number one, which is consumers rise to meet GLP-1s. Why? Because that's where valuations are too depressed. That's where expectations are overly pessimistic. That is where the narrative that GLP-1 trends are going to continue even more aggressively into the future and deplete the market share and the demand for these products, right? And while that is true, it isn't as big as the market is making it, right? Keep in mind that the GLP-1 wave has been contained to the US, where most obesity diseases are centered, where most people are looking to those drugs, right? That's not happening in Latin America. It's not happening in Europe. It's not happening in Asia, right? It may be happening, but a much, much lower adoption rate and a much slower rate, right? So maybe the market is assuming that every single company across the world is going to be affected. And again, there might be some, there might be others that don't, right? And that is the entire premise of this trade, and it's been shown in the data. Now, the Z-score is one way to time this trade, right? So the Z-score is sort of a rubber band that whenever it hits a limit, you could pretty much bet that it'll converge back to a normal elasticity, right? If you think about it like a rubber band, right? So you can see the baskets of consumers versus GLP-1s and their Z-score. So whenever the spread between the two get too far apart, they tend to converge. And they take around, like I said, 6 to 12 months to do so, just as the correlation show. So right now, we're coming off the second band, and it's been a year, right? So it's been one full year since we hit a second standard deviation in the Z-score, meaning the rubber band has to snap back into normal stretches. That would mean we are expecting that the consumer basket is going to outperform the GLP-1 basket in the coming months, right? Toward the end of the year, maybe the following 6 to 12 months again is going to have the opposite direction as we saw from late 2023, early 2025, right? So all of that to say that the timing is getting pretty close to putting this trade on. Now, we have to outline the catalyst. We have to know when it's time to put on this trade, even though the technicals on the Z-score is already telling us to do so, right? So right now, the big catalyst in the GLP-1 space is already gone, right? The pill form from Eli Lilly being released, that was pretty much a big catalyst, right? So now we have the new risk coming in, which is competition. Like I mentioned, more competitors, more supply, price wars, compressing valuations. So when you take all that into account, I think that the upside is much more limited for GLP-1 trades than it is for the consumer, right? Because the adoption of GLP-1 is already priced in on the pill catalyst, on the adoption catalyst, meaning the opposite effect on the consumer names is already priced in as well. So now that the market has no further catalyst on the GLP-1 side, they should have no further catalyst either on the consumer side for changing trends. That is essentially the entire thing here. So let's look at what GLP-1s have changed effectively in the consumer space. So we have drinks and snacks essentially. So snacks have been the worst case here, falling by 3% in growth over the past 3 years, right? So they've had a $12 billion write down on demand globally when it comes to like Coca-Cola, Pepsi, Frito-Lay, all those brands, right, are having a decline in market share, a decline in demand based on GLP-1 trends. What is having an increase, though, is energy drinks, functional, and hydration drinks, right? This is the area of the market that is showing like sugar-free drinks, additive-free drinks, and naturally aspirated drinks that Pepsi is making, that Celsius is making, that Coca-Cola is making. So like these brands know the effects of GLP-1s are centered around snacks, not drinks, right? As long as you make the right drink, then you're good, right? So these companies are making the right drinks tailored to the people that are exposed to the GLP-1 wave, which is why I think as long as we find something in this trade that makes the right drinks in the right market, we're going to be fine, right? And when you look at it this way, I mean, the ones that have the snack portfolio, let's say a Coca-Cola, let's say a Mondelez, they have big international demand. They have huge international markets, right? So as long as the GLP-1 wave is mostly contained in the US, which it is, roughly 95% of users are in the US, then I think that the international markets are going to keep delivering and keep carrying the weight for the broader snack section or segment of the business, right? At the same time, if these same businesses make the tailored drinks to the weight loss wave in the US, then they're going to see increase in demand, increase in revenues, right? So if you mix those two, when you have a company whose snacks and food business makes less than half of its revenue from the US, I think that's a good play. I think that's a good catalyst. I think that's a good repricing opportunity that could happen. At the same time, when those businesses have a drinks business or a drinks segment which is centered around the US and it's making those tailored drinks like sugar-free, additive-free, naturally aspirated drinks, I think that's another great repricing opportunity. So again, snacks outside the US, as long as you have more than 50% or less than 50% in the US, great. If you have most of those drinks being made in the US and it's tailored to the weight loss wave, great. I think that's where we should center a typical trade idea in this sort of theme. Now, this is the two-part filter that most people never think to run, right? So this is exactly what I just mentioned, guys. This is the snacks and beverages with less than 50% revenue in the US. So you stay outside the GLP-1 market, you mitigate the risk of fall in demand, and you stay strong, driven by international markets. The second filter, again, is US-centered beverages, right? Focused in the hydration and functional energy. So that would be no sugars, no additives. So this is the exact profile of consumer that you're serving in the US where GLP-1 is centered. So again, keep these two filters, take a screenshot of the two and do your research accordingly, right? But that's exactly what I'm hunting for, and the setups look amazing. They look fantastic for another run like we saw in Domino's Pizza. I mean, 7% in a day, that's insane. Now, the smart money is already hedging the repricing. And this, every time I look for an idea, I like to see these sort of catalysts before I tell you about it, before I do hours and hours of research into it. So right now there are 40,000 XLV December $100 strike puts, which means a lot of interest is going toward the healthcare sector itself falling, right? So it's right now trading at 163. They're looking for it to go to 100 by December this year, right? So I think that what happens here is if the market reprices the catalysts that are already out there, right? The big catalyst everyone was waiting for in peptides and weight loss was the pill form. Now Eli Lilly is out. What happens next? I already told you. There are going to be competitors bringing better pills, cheaper pills, better margins, and everything else. They're going to start a price war with everyone else. And what happens is the market expectation goes from a positive catalyst to a flattening or even negative catalyst, which is why I think traders are already putting on this position, right? 40,000 puts for XLV December $100 strike. That's not peanuts, guys. That's a big bet going on in this equation. And I think it's driven by the catalyst factor that I just mentioned. Now, the process is the product, right? You need to have a process. You need to have an idea generation system that's repeatable every single day in every single sector, every single area of the market, right? Because you need to stay flexible. Now, you have to come into the offside premium factor to get the true value of this trade, right? I gave you the setup. I gave you the area that's going to play out. I gave you why it's going to play out. I think that the consumer basket is going to outperform GLP-1s. I told you step by step why that is. And I even showed you that there is smart money options traders playing behind this thesis, right? Now, the two names that I've found are being pitched later today, probably after you watch this video, inside Offside Premium. You could look at the initial post in the newsletter, but the valuable insight is going to be behind the paywall. I suggest you check it out. I mean, we're putting out a system or an offer, an introductory rate where you get $125 a month before the real rate of $250 a month kicks in. You get 3 months of that to check us out, make enough money to cover a year, 2 years, 3 years worth of membership, and then you come talk to us, right? But what I'm saying here is I did the research for you. Now, the two names that I'm playing in this theme, the ones that have the beverage revenue coming from the US, tailoring those drinks to the weight loss wave, the ones that have over 50% revenues coming from the snacks segment outside of the US, mitigating the weight loss risk. I mean, that's a lot of homework, and I did it all for you. It's coming to you in about 3 hours time from when I'm recording this video, and the trade structure will be alerted to you right to your inbox. So yeah, big one today, guys. Hope you got a lot of value out of this. Save the presentation if you want. Do your own research on this one. I think it's going to be a great rotational play toward the end of the year. Again, I'll keep you updated on the portfolio performance. Today is a great day for Domino's Pizza. Let's see what the software names do next, hey? Now, good luck. I'll catch you in the next one.